Hello and welcome to the Alt Asset Allocation Podcast. Today's interview is with Harley Bassman. This was the first recorded interview of 2021. I know I'm behind, but the world of financial assets feels really out of control right now. And in these times, it's oh so common to hear the phrase, "It's different this time." What I love about Harley is that he contends that if you look hard enough, you'll see that it's never different this time. We're all humans driven by the same things, which is actually refreshing sometimes. Harley was the inventor of the popular MOVE index, MOVE, the treasury volatility cousin of the VIX. Since then, he is retired and continues to make a name for himself, giving away decades of accrued wisdom for free on his blog, the Convexity Maven. Highly recommend checking it out for his writings. There's tons of great knowledge there. In this conversation, we talk a lot about his most recent pieces, Wages of Fear and the 2021 model portfolio. We talk about financial markets and some key drivers, including inflation, interest rates, and key demographic shifts. We go into detail on portfolio allocation and some great ways to position your investments over the next few years. There's a lot of gold here, that's for sure. Before you listen, please don't forget to like or subscribe to the podcast, or even better, leave a review. If you're watching this on YouTube, please subscribe or like the video. I really appreciate it, and it really, really helps. Apparently, that's what they say. Either way, enjoy the conversation with Harley Bassman. Harley, welcome to the show.
Thank you. Happy New Year.
First guest of 2021. Happy New Year to you as well. Both of us in sunny California. This is great. Maybe next time we'll do it in person, in 2025 when we can all move freely and talk without masks on, I suppose.
Better be sooner than that.
Oh my God, I hope so. Well, I'm excited to have you on the show today. You run a great blog, big fan of all of your work. But before we get started, just for my listeners who don't know who you are, can we get a little bit of your background, who you are and where you are?
Sure. Native of California, U Chicago MBA, so I'm a monetarist for whatever that means to people. Seeing that's been, I guess, disregard for a while now. I spent most of my career, 26 years at Merrill Lynch, where I ran mortgage and option businesses. Came out to California a few years ago to work for PIMCO, one of their hedge funds, and now I run a hedge fund of one myself. And I write I call it an episodic commentary, not a blog, but it's all the same thing. And people are welcome to sign up for it. Go to my website, convexitymaven.com. It's right there, and you can send me an email, I'll add you, and it's free. So you get what you pay for.
Yeah, absolutely. Episodic. What would you call it? Episodic what?
Episodic commentary.
Episodic commentary. I love it. No, and the convexitymaven.com, I'll link it up in the show notes, but fantastic resource. Really love a lot of your writings. And before we get into that, you were the creator, the inventor of the MOVE index. Is that right?
Yes. I spent the better part of 15 years trying to get anyone to care about it. I talked to the Journal, the Times, Barron's, Bloomberg, all these people, and they didn't care that much for it. And in the last 10 years, it's become actually rather popular. Not sure why that is, but I'm happy that it's working. It was created almost the exact same time as the VIX. When the VIX came out, it occurred to me that we should have something similar for bonds. And I constructed that in a way that would be very simple and that would, it can just feed right off a machine. There'd be no dealer marking it. It's just automatically it's done. It's a way of, it's like an unscaled absolute index. So it's a clean read, and you can say something is double or half of what it used to be. And it was my way of helping people involved in optionality or convexity have a rough idea of what zip code is volatility in. The horses went that way, boss, kind of thing. Is it 80 or is it 120 or now it's in the low 50s? That was the idea.
And I mean, when people are using the VIX or the Move Index, do they use one or the other, or use them both in conjunction with each other? How do investors use these index or
Um,
use these tools?
well, the move you can't trade. The VIX you can. Actually, that's not true. You cannot trade the VIX. You could trade futures on the VIX. You could do options on futures on the VIX. This is a very important technicality because futures trade different than the spot index does. And people think they might make or lose money based upon these things, but I think people get hung up a lot on the pricing and the valuation of how the two of them move. Also, the move is an actual at the money option. So it's a blend of options, 1 month options on the 2-year, 5-year, 10-year, and 30-year. So it's a direct drive, like a transmission with one gear. The VIX is different. The VIX is not the at the money option, of a 1 month option on the SPY or SPX, or the SP 500. It's actually all the options, the calls and the puts, up and down, blended together. And so if the VIX is 25, that does not mean that an at-the-money option is a 25 vol. And this actually is a very interesting little, once again, technicality that's kind of tricky. The VIX usually trades 2 to 3 points over an at-the-money option. So the VIX is 25, an at-the-money option might be 22. What you have right now actually is a much wider spread. It's actually about 6 points. So if the VIX is 25, the at-the-money option might only be 19. And the reason for that is it used to be that if an at-the-money option was called 20, an out-of-the-money put might be 25, an out-of-the-money call might be 18. It'd actually be lower than the at-the-money. So instead of like a smile, you have a smirk, right? With the upside volatility to new highs, but more importantly, with the Robinhood buying of out-of-the-money calls on all the single names, which when combined together gives you the index, you now have a full smile where the calls and the puts are both above the at-the-money. And so the VIX has been elevated to a 6 point spread as opposed to a 2 or 3 point spread. So the VIX is actually, I won't say artificially elevated 3 points higher than historically it's been, because it's not artificial, it's how it was designed. But if you look at a history of the VIX going back forever, the VIX is now 3 points higher than it used to be, all else equal. Does that matter? Not too much, but it is something for people to be aware of if they want to get into the weeds.
And I definitely I want to go into more detail on these things. I wanted to start a little bit more high level, but that's incredibly interesting. And I've always been trying to think through how this massive amount of Robinhood traders playing options is impacting different things. So it's good to know that, well, obviously it is impacting things, but it's skewing the whole reading of something like the VIX. That's just mind blowing. And I'm not sure how that impacts other aspects of the market. Is there something that you can just point at within the market and say this is impacting it this way, or it's kind of included in a number of different ways, in ways we can't really point out that easily?
For real option geeks, market makers and professionals, this is meaningless to anybody. So anyone listening to this podcast, you don't care about it. So I'm sorry to mention it, but you asked.
No worries. Yeah, no. Well, it's very interesting. And I mean, the move is still around and tracked by a lot of people, and you were credited with creating that. So really, really awesome stuff. As we said on your website, on your episodic commentary site, you have a lot of really good commentary. So I'd like to just start off with your overall global macro view. What's happening in financial markets? Your last two pieces between the Wages of Fear and your 2021 portfolios, I think, kind of package these things up nicely. So do you mind just kind of talking to me about what's going on in financial markets?
I think it's pretty easy. If you are interested in nips to blips, if you're interested in short-term trading or day trading or anything like that, then turn the video off. You don't want to listen to me because I don't care. My horizon is 2 to 5 years. I'm an investor, not trader. And that means the most important rule of investing is sizing is more important than entry level. I really don't care about the price I get in at if I like the idea and it makes sense to me, because I know I can't time it. And there's plenty of studies out there of people, if you miss the top 10 best days of the year, you lose money, something like that. And the odds of you finding that are nil. So what's the big picture? The big picture is twofold. One, we've had 10 years of QE, money printing. And the initial QE after the financial crisis was a good idea. We are a leveraged financial economy. Okay, that's what we do. We're not gold-based anymore. It's levered money. And therefore, the plumbing of this money has to exist. You can't rip the plumbing out. And so when you had a crisis in 08 and 09, between the clearing and the banks and everything else, the government had to step in to save the plumbing. Now, is this a good deed? Do these guys deserve to be saved? I can assure you that my boss at Merrill Lynch deserves to be in jail, as far as I'm concerned. And did Obama and Justice make a mistake in not prosecuting these people? Definitely, positively. I mean, they went after guys in '89 for less. But nonetheless, QE1 had to happen. After that, was that a good idea? It was good in spirit. It was bad in the result. And you had a public policy bad, because what happened is the printing of money in QE 2, 3, 4, infinity created inflation, but the inflation went to assets, not to wages. And thus, you've exacerbated all of our problems by widening the income gap, the wealth gap, and everything else. That wasn't the Fed's intent, but that's what happened over here. Because the money had to go someplace. Why did the Fed want inflation? Is the question you're supposed to ask next. And the answer is, we had too much debt. After 08, 09, we had too much debt. We had to get rid of it. How do you get rid of debt? There's 3 ways. Well, there's really 2. The first one is you grow out of it. It's what we did after World War II. That's not going to happen for a lot of reasons. So off the table. So you have 2 ways out of debt. You default or you inflate. And inflation is a slow motion default. So since the Fed did not want the defaults, which would cause unemployment and other problems, they said, let's create inflation. That was the idea of QE and all the money printing. They got the inflation in assets, not in wages. That didn't work. They're trying it again now, but it's different now because we're going to have fiscal policy along with the QE. The fiscal policy is going to put the money in the hands of people who will spend it, as opposed to putting money into the banking system, where it'll just get absorbed into stocks, bonds, gold, real estate, and everything else. So this new plan is going to work. Now, in conjunction with that, so that's the top, the surface of the ocean, which we can see of this giant iceberg. But as you know, an iceberg is basically 90% underwater. The underwater portion of this is the demographic. And I have many charts in my writing. You can go through my website and go look them up about the demographics over the last 60 years. And what you had was this baby boom explosion, people born 1946, 64. As this pig in the python works through the system, you had the big inflation in the 70s and 80s, and then since then, this collapse of inflation and interest rates. Why? Because the average boomer was born in 1955, which means in 1985, that's the big bulge, but the leading edge is happening in the 70s. And what do? The boomers got married earlier, had kids earlier, formed households earlier. When you do that, what happens? Well, you buy a washing machine, you buy a baby stroller, you buy a car, you go on vacations with the family, you're spending money. You have big demand. You're demanding from a supply. Who's the supply from? That's from the World War II generation, which is smaller. So there's more demand than supply, and up go prices. And you can measure this by the growth of the labor force, because labor force's age is 18 to 65, or you can winnow it down if you want to 25 to 55, most productive years, whatever it might be. If you chart labor force growth versus interest rates and lag it by 5 years, it's the same chart. Labor force growth is going to turn up 3 to 5 years from now. And I've been writing about this for 10 years now. Because the demographic is baked in the cake. You can't be reborn 10 years ago. We know what it is. So therefore, 2023 or 25, labor force growth tips up, and you should see interest rates tick up, and you see inflation tick up. And when you combine that demographic with QE and fiscal policy, there you go. That should create the inflation, which should also create higher interest rates, although it may not. The Fed could hold it down and just create negative interest rates, okay? You will get the inflation, and will it be in rates? I think it will be. Because the reality is that the Fed wants a steeper curve. They want to keep rates low in the front, but a steeper curve in the back. Financial institutions do better, and pensions and insurance companies all do better with insurance companies. So, that's a steeper curve is not a problem for the Fed. In reasonable terms. So that's the big picture and so you want to invest accordingly to that.
Yeah. And I think that paints a fantastic picture. The world has been drunk on cheap debt. You have these demographic moves that are really going to impact things. I love your comment about sizing is more important than timing. But as one of your mantras that I see a lot on your site is it's never different this time, which I love, because especially right now, I find myself always saying, oh, it's so different this time. The government debts are so much higher. The world's very indebted. Rates can never go up because of the size of these debts. We have these crazy new things like MMT that are coming out of the woodworks. It's totally different this time. So I think it's a great gut check to read your blog and say, no, it's never different this time. So I'll challenge you. All of these things that you said, all of these factors that are moving around, how do you piece through these and say, no, it's never different this time? Are you looking at somebody like Japan? Are you how do you rationalize this when it does feel, in fact, so different this time?
Well, it is never different this time. The problem is you just don't live long enough. The cycles and the movement are longer than your 40-year investment career or 80-year life. So that's why you never see these things, but they all happen over and over again. There's a reason why we read the Greek tragedies, we read Shakespeare, and then I'm not gonna get into politics about what we read nowadays, but why do we read these things? Because nothing has changed. What is the great destroyer of mankind? Hubris, ego, greed, fear. That's not different. And those will happen over and over again. And we will have speculation, and we'll have fear and cycles. MMT is not new. Okay, it's just called something different. But once upon a time, you've always had, the kings and queens of the realm will go and, shave off the edges of silver, or create some kind of other currency. And this has always happened, and we know how it ends. The thing is, these cycles can take a very long time. And the Roman Empire took 400 years to cycle on through. So, the fact I'm talking about, post-World War II cycle of 60, 70 years, kind of nothing, man. Now, as a trader or an investor, you really can't trade for 100 years. You kind of got to trade. Your window really is probably 10, reasonably, to operate in. So that's kind of the big.
No, I think that makes a lot of sense. Ultimately, we're all just monkeys with the same primal instincts, and it always goes back to that. So I do get that, but so talking about this bigger picture, as an investor, you have these shorter time periods. Now it's different. A hedge fund of one, thinking of multi-generational wealth and preservation and things like that. That is perhaps a little bit different, investing across multiple generations, but knowing that, okay, inflation, it has to come. It's definitely coming. And it has shown itself in asset prices, and now they're going to direct to consumer, encourage people to spend, get the velocity up. It's coming, but if we do something like MMT, which we likely will, the
We're already
enemy.
doing
Yeah,
it.
well,
We're
I mean,
already
it's
doing it.
here, but I mean, like full on, just floodgates open to MMT.
You don't think $900 billion, which is 4% of GDP, is like a number? I mean, we're spending more now than we did, like, for World War II. I mean, this is like, compared to the Marshall Plan, inflation adjusted, these are utterly gigantic numbers. Are they justified? Is it reasonable during a pandemic? Yeah. As a public policy idea, is a great idea? Yeah. So I'm not saying we shouldn't do it. I'm just saying that let's scale this thing properly. These are very big numbers.
They are very big numbers. And I think that's almost a benefit of them because they're so unfathomably large that people, it's just a trillion here, more billion here. It is what it is, right?
All we have here is this. It could be 20 years before we get the inflation. That could easily happen. And Japan is proof of something, I'm not sure what. Japan is all, I mean, whenever I talk about any of this nonsense, the only reasonable pushback is, what about Japan? Because their deficit is vastly larger than ours. Their QE vastly bigger than ours. So what a different demographic, which is old and shrinking. The money they're borrowing is internal money. Most JGBs are owned by locals. It's not international business per se. So they owe it to themselves. They have a massive savings there, generational savings, which is much bigger than anyone else on the planet. And in theory, that savings offsets the JGB debt. So they kind of, you're picking one pocket to the other. So it's a little different. If they default, they're defaulting themselves. If we default, we're screwing China, which, by the way, is not a bad idea at all. But that is the defense we have of an external debt. But we print our own money. So this is why third world countries always have a problem, because they borrow in dollars and they can't print them. But we can't print dollars, so we could push ahead. I mean, it's almost like, I guess it's almost like gravity. You either or religion, you either believe or you don't. I mean, if it's possible to print the currency of the realm at a faster pace than the growth of the actual, economy, and it doesn't cause a problem, I suppose that's fine. I don't see how it can be. If you only have X amount of loaves of bread and you double the amount of currency out there, then at some point bread's got double in price, or else they make more bread or whatever. MMT is not wrong in the concept that you can borrow. What's MMT? Modern monetary theory. And what it says is that you can borrow, the government can borrow money as much as it wants, as long as there is slack in the economy. So the idea that I could print the more money in my last example, but we can make more loaves of bread. There's bakers who were on the beach who, if there's demand, they'll come from the beach, they'll go to the bakeries, and they'll make more loaves of bread. So that's fine. When you run out of bakers, so when you've used up all the slack in the supply, in your capacity, then you get inflation. And that's the signal that you've reached your limit. The problem you have there is that no one has a model for inflation that's viable. Nobody, not the Fed, not Wall Street, not anyone else. We don't know, we can't model it, we have no idea where it comes from. We can't predict it. So therefore, you'll only know inflation has arrived when it arrives. And of course, by then it's too late. This is like being on a diet. You stop when you're fat. I mean, it's too late. The other issue is, even if you had that model of inflation, let's think about the government is borrowing money and spending it. We have a policy of how the money is spent. To go and say, okay, we've reached our limit, means you now have to go and reduce that spending, because the old spending was a deficit number. So you got to take it down so you stop borrowing. How are we reasonably going to go and dial back? That is just not going to happen. I mean, we could say we're going to go on a diet, but we're not going to. It's just not realistic of the way politicians work. They're elected for a very short term, and the way the carrot and stick is created now, it's unreasonable. So is MMT wrong if it was actually implemented as they say? that we'll borrow money as long as there's no inflation. And when the inflation comes, we will cut back. We will cut the government budget by 15%, or 20%. That's fine then, but they're not going to do that. So that's the flaw in the whole thing.
Yeah, certainly. And I mean, I don't want to go down that path of short-termism and issues with all of this, because that's certainly playing into a lot of this, right? But something that I thought about when you were talking is like the Titanic floated until it didn't, right? Everything works until it doesn't. And I feel this exact same way about MMT, but knowing that MMT is here, that it will just get more and more drastic from here on out. I mean, politicians will give more money. They'll forgive the college debt and this plays into your whole hypothesis about increasing consumer spending of the millennial class. Like, you pull off their debt load, they're going to have more disposable income to spend. But knowing that the Fed and the governments will be monitoring inflation, whether it's CPI or other, and combating that, it feels counterintuitive to position your portfolio knowing that inflation is coming, and you might be in a world of hurt in the short term. Is that fair?
I think we got to think about two things here. I don't want to delve into politics too much, but it's, as much as I just said, the MMT is not because it's not going to work, but it's not going to work. I guess it will work in the grand scheme of the Fed wants inflation, the government wants inflation, and maybe having inflation is better than Plan B, which is having lots of people, thrown out of their houses, not be able to get food, not having jobs. I mean, maybe this inflation is better. And the reason why inflation might be a better idea is it's a silent tax across the entire country. So there's two good things about it. One, it's silent. The politicians aren't raising taxes or things like that. And number two, it's universal. It goes across the entire country. Is it regressive? Yes, it is a regressive tax, which is bad. But maybe that is the best way to go solve the problem with this. Now, from an investing standpoint, what do we do? So let's throw in the public policy idea and now look at our own personal portfolios. What you want to do is own things that, I don't want to say are solid, you can get your arms around, but things that have real value that will hold them. If you look at Chris Cole, I suspect you've interviewed him or you will someday. I've stolen so many of his ideas, thank God. One of the brightest guys out there. He wrote a piece, brilliant, 7-8 years ago. It's on the internet, you can go find it. And he has a chart in there about the German stock market during Weimar Germany. And yes, you have the people pictures of wheelbarrows full of worthless, Deutschmarks. But the stock market actually kept pace with inflation because Volkswagen, Daimler-Benz, these guys they're real companies making real things. They're going to raise their prices with inflation because it's a real asset there. And is there a lag of years? Yeah, but I mean, over the course of time, you own a real asset there that's going to hold value. This is why gold is an interesting idea. Is Bitcoin also in that camp? Maybe. But real estate, clearly real estate will hold its value. Will real estate go down initially? Yes. When you get the inflation, you will likely get higher rates. If you get the higher rates, then the discount rate, either the cost to borrow money or the cap rate on a commercial property will go up. If you raise the discount rate, then the forward dollars are worth less today, and therefore the price of the asset goes down. So you will initially have prices go down of assets, but over time they'll catch back up again. So owning stocks in some sense is an inflation hedge. People will fight and scratch about that, but you are owning a real asset as opposed to owning a bond, which is clearly a loser because you're promised X dollars of fiat currency X years from now. That's clearly a loser. So moving into real assets is the concept. Um,
Yeah. Yeah. But I think this rhetoric is kind of spreading a little bit of like, get out of cash. It's being devalued. There's going to be inflation, which are two separate things, but still, like the impact is the same. Get into some sort of asset because cash is going to lose its value. But so, so I get this. This makes sense. But in terms of like, and perhaps we're going back, and I definitely like to talk about the picks and positioning your portfolio, but this just screams to me further wealth inequality and the divide and further issues around that of the people that have assets and are able to invest, and the people that don't and are living paycheck to paycheck. They're the ones that um, really get screwed or hurt in this situation, and that just leads itself to more government support and kind of just this disgusting cycle that I see that ends with pitchforks and torches in a pretty pessimistic state, right?
well, there's a timing issue of how long it happens. I mean, these things could be many years. And I own gold. I'm not a gold bug. I mean, I'm not one of those crazy guys, on TV saying buy gold now or buy silver now. It can be quite a while. Gold's a very long-term asset. It's got to be a 10-year, 20-year cycle in gold. For a lot of these things, public policy, we are betwixt and between right now with what to do there. And I agree that a lot of these policies are helping the wealthy. If you do look at the charts of wealth concentration, we've had two cycles of this, and both these cycles have reverted, not because the government raised taxes or anything else. They reverted because asset prices went down. The stock market, breaks in the 30s and again in the 70s, is when you saw wealth inequality collapse. Because by definition, the wealthy have assets and the poor don't. That's why they're poor. That's not a good thing, but that is a the effect. So I mean, how the government resolves that is unclear, because I don't think they could actually wave their hand, but it might work. But if you do get inflation and you do get higher rates, you will initially get lower asset values. And I can almost assure you that if you get rates above 3.5% to 4% on the 10-year, you will see a compression of the wealth gap, and you'll see other bad things happen, which is why I've structured a trade, which I am trying to find a way to bring it to the common man. I have not found it yet, but these long dated, like 7 and 10-year options on interest rates, that's the master hedge for this whole thing. Because what you're really going to worry about is if you do get rates above 3 to 4%, what you're going to see is presently what we have is stocks and bonds go up and down to opposite directions. Stocks up, bonds down. Like look at today, SPOOs are up 38 points, and the bonds down 10 bips higher. So if you have a levered portfolio, a risk parity portfolio like Bridgewater, how they become famous, he's the first guy to figure this out. You have $100. The risk parity is this. They go up and down in opposite directions. You have $100. You buy $70 of stocks. You buy $130 of bonds. So now you have $200 invested. You have to borrow, $100 from somebody. Forget that. And you get that ratio of 70 to 130 by the correlation of stocks to bonds, which is basically simple calculation. You can do it at home. Just take the prices every day and figure out, and then you adjust that ratio. So you could go 65 135 or 85 115, whatever it might be. That portfolio exists because they go in opposite directions. If you get rates above 3.5% 4%, you will see that correlation flip, and they do this up and down together. And if you get down together, well, and you're levered 2 to 1, that's lights out, man. That's what happened in March, and that was really because you had stocks and bonds both going down and gold going down. Everything went down together. Correlation, one trade, and that's when the Fed really stepped in, because that was like all of a sudden it was margin call across the board for everybody, and there was no money left. That's when the Fed had to come in with 20 bazookas. If we get rates above 3 to 4%, it may not be immediate. It won't be a panic sell, but you will see both asset classes go down. And if you look back over the last 70, 80 years, you will see that the correlation of stocks to bonds averages 0. There's no correlation. It goes above, it goes below. But when it goes up, when they go together is when you have higher rates. And there are charts that I've produced in my website from Bank of America, from Credit Suisse, and from Gerard Minnick in Australia. They all show the exact same thing at the exact same location.
So that's something you're monitoring and watching very closely. Is you said 10-year treasury above 3.5? That's kind of the benchmark, yeah. But just go heading up that way and things could get really ugly, right?
Oh yeah.
I mean, this.
Which ain't happened. By the way, we got at least 2 or 3 years before that happens, because right. The demographic, like we don't get that lift in labor force growth until 23, 24, 25. So there's time to go here. Don't panic, man.
Right.
But that's what's coming.
Well, and so teasing that one out, I mean, that's the death of the risk parity portfolio, but it's also the death of the gold standard portfolio, the 60-40 stock and bonds. If you have this bond portion that's supposed to offset your losses when stocks go down, well, if they're all correlated, they're not a very good offset. They're not a very, very good diversifier. So, I mean, I had Vincent Dillard talking about the nuclear winter of that 60-40 portfolio. So he wins the title for the best title with it. But I mean, so transitioning toward that world where bonds don't work as a hedge in your portfolio or diversifier, where are investors going? They're going further out the risk spectrum. Like they just continue to hold bonds and they don't function the way they used to function. How does this work?
Well, I'll push back on the idea that 60-40 is doomed. I mean, 60-40 is just an unlevered risk parity portfolio. Okay, but we had 60-40 40 years ago, longer than that. I mean, the old rule on Wall Street was you invest your age in bonds. So when you're 25, you have 5% bonds and 7% stocks. And when you get to be older, you reverse them because your horizon is shortening. So you had that going on in the 60s and 70s. That rule is not brand new. What you're talking about, which is correct, is that the hedge value will go away. But in the 60s, 70s, and 80s, the correlation went positive and negative back and forth often. And I have charts of that on my website also. So so I wouldn't call it the demise of that. I would still recommend being diversified. It just won't be, it'll just be more volatile because the correlation will be going the same direction. What do you do about that? I think what I've done is printing all this money does lower interest rates. The Fed QE does lower rates, which pulls everything down because it forces you out of treasuries and into other things. But the underlying risk, the default risk, hasn't changed all that much because the companies aren't getting the money. They're just, they can just borrow at a lower rate, I suppose. So I'm not sure defaults actually are improved dramatically. But the Fed's giving me the ability to borrow money at a very low rate. So I prefer to get rid of my credit risk and take on leverage risk. So if I owned a fund or closed-end fund or some kind of fund on junk bonds 5 years ago, I've sold those and I've bought mortgage REITs and closed-end funds on muni bonds. So like muni quality, not the junk bond, quality muni closed-end funds, they yield 4.5%. And those have no Illinois, no Puerto Rico, no Connecticut, no New Jersey, all the crap you don't want to own. Is California crap? I don't know. It's certainly better than Illinois or New Jersey. Is New York bad? New York is not. As much as everyone hates New York, maybe the MTA is a problem. But something to understand is that in California, half of the personal income tax comes to the top 1%. As a public policy matter, is that good? No opinion. The problem with that is it's a very volatile number because if stocks go down, the top 1% have less income and therefore they pay less taxes. That's what happened in 08 and 09, and that company got into a pickle. In New York, most of their money comes from property taxes. Prop taxes are very stable, and people got to live somewhere. And people tend to pay their taxes first because they don't want to lose most people want to default. They pay the property taxes. So therefore, New York's actually a much more stable financial environment, New York State, than California. But the pension problems in New York State and California are nowhere near as bad as Jersey, Connecticut, or Illinois. So I mean, I have no problem with owning those assets. And if I can get a triple tax-free four and change, is that bad? How do they get it? They get it from leverage. Fine. I'll take the leverage risk because I think the Fed is keeping rates at zero for at least the next 2 or 3 years. They've said they're going to do it. The market's pricing they're going to go and do it. And therefore, if I can go and take leverage risk to enhance my yield, as opposed to credit risk, I like that. And then I can either hedge or not hedge that the duration component. But if in my tax bracket, I'm making 8% on these things. Fine, I can live with that. I made dumber trades than that.
Yeah, well, I mean that makes complete sense versus going into a corporate bond fund or something and taking on all of that risk. I get that, and so this is a good transition into your model portfolios piece. So one of them was these municipal bonds, closed-end funds, and you mentioned in there definitely not Illinois, New Jersey, Connecticut. That makes a lot of sense. You mentioned Puerto Rico as well, which probably is a good choice to include not in that no list. So I think that makes a lot of sense. And then you also mentioned mortgage REITs. So can you talk a little bit about mortgage REITs, and for my listeners that aren't familiar, how that's different from like an equity REIT?
I think the mortgage REITs is probably the best trade out there right now. There's a risk involved. What happens is this. So an Annaly or AGNC are the two biggest mortgage REITs out there. And they basically buy Fannie, Freddie, Ginnie mortgage bonds. They're basically government bonds. There's no credit risk. They're not going under. And what these guys do, and mortgage REIT is so a property. Most of the REITs out there are either equity or property REITs, where they're buying the actual hotel or the shopping mall and then borrowing money against it and then making money. Blah 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 blah. These guys don't do that. They buy the bonds. In this case, bonds backed by home mortgages. Very simple. They will then, so they have $100. They'll go and they'll buy $700 in bonds and then borrow $600. So they're leveraged 7 to 1. So what's your first risk? You're borrowing $600. If that borrow cost, which is now like under 1%, goes up, that's bad. Okay. Well, the Fed's told me they're not taking that rate up for 2 or 3 years. Okay, that's good then. They have a mortgage security. It's like a 7 to 10 year treasury. The risk of it is. So if rates go up, it can go down by a lot. So what do? They then sell. They use derivatives, but forget that. They sell 10-year treasuries. They got 700 bonds. They'll sell 700 million 10-year notes against it. So now they got that duration boxed up. Not quite. Because what happens next is a mortgage security is callable. If you have a mortgage, if you're watching this show, you likely do, you can pay off your mortgage whenever you want. So that mortgage that you have, which is packaged up and put into a Fannie Mae bond, that bond is actually, it could be a 30-year, it could be 1 month. You never know what's going to be called. And that's this is what I did for most of my career, is the optionality, the convexity of those mortgage bonds. Like, how do you figure it out? Okay, so that you're short a 10-year treasury, but you're long is either a 3-month piece of paper or a 30-year piece of paper. Hey, what's it going to be? Okay, that embedded optionality has to get hedged out. And they go and they buy options against it. Well, as we started the show, we have the move index. Where's the move? The move's in the low 50s. It's at record lows in volatility. So the cost of buying back that optionality is at forever lows. That's the whole idea, is that all these risks are basically vastly reduced from where they've been. So I have my financing cost is pinned by the Fed. The back end rate is hedged out, and the actual movement is going to be diminished because the Fed's going to do QE and keep holding rates there. And even so, instead of moving 2%, you can move 0.5%. Even at 0.5%, the cost of hedging that convexity out is now been reduced because of low volatility. And these things yield 9-10% right now. So yeah. that's the whole idea over there.
I think those are great picks. So the public ones that you mentioned, the big ones, Annaly and what?
AGNC. I prefer AGNC. There's other ones out there that also do other things, which get a little more complicated. You can look them all up. And what they'll do is mortgage servicing, or they'll do non-agency paper. They'll do adjustable rate mortgages. Some of them will do commercial mortgages. The BDCs out there, like an Ares Capital or a Ready Capital, like they'll go and they'll be very high in the capital structure. They'll make loans to people or to businesses and then lever them up. But once again, the credit risk is very low. The money really is the leverage component, not the credit component. And so that's the risk I prefer. Now, 3 years from now, am I going to be saying the same thing? No, I'm not. I'm going to be a lot more worried, but I'll clip that coupon now. Next.
Yeah, so that makes sense. You're basically holding this until rates starting to go up, which is like an existential risk to these things starts ticking up, which you've talked about, and then it's, you do not want to be in mortgage REITs at that point of time.
Yeah. The trade along with that is, I presume you're going to talk about the S&P option trade, or you
so you have a couple other good picks in here, and I think the reason why I like a lot of these picks is it's very you talk about your thought process, and they're different from like the average pick. So why don't we jump into the SPY options?
Just to make sure, so it's on my website under model portfolios, and this is my PA. I own more than this, but everything that I've written about, I own. I'm eating my own cooking here. So we're gonna. A lot of people said that the Democrats win everything. It's going to be like nuclear winter for the stock market and the bond market. I've never been a believer in that per se. I'm not saying that Democrats are good or bad. It's like I put not too much value in these predictions. But it is pretty clear that the Democrats, if you do get them, you're probably going to have more spending. So the MMT fiscal policy is probably going to be greater, theoretically. Although it does seem to be the case that Republicans have put us in a bigger debt than the Democrats have over the last 60 years, which is kind of weird that the Republicans claim to be the fiscal conservatives. It's been totally backwards. Clinton balanced the budget. Obama almost, shrunk the thing down. Forget the politics there. But I think you're going to see a cycle, either party, Democrat or Republican, of spending and QE and fiscal expansion. And that will initially help stocks, only in nominal terms. And I felt that I had a floor on my position that we probably would not go much through 250, 2,500, 2,750. Because you get PEs there around like 17, which with rates down to one, that's a pretty good deal there. Remember, the PE is the inverse of the earnings yield. So PE is 17 means you're earning 6% on your money, and if 10 years are 1%, if junk bonds are 5%, I'm still earning more than these other alternatives. And I know Schiller says that there's no interest rate component to CAPE. He's wrong. He's smarter than me, I suppose. But I just don't buy the fact that rates don't have an impact on investment decisions. So I kind of figured that you're floored out there. And so I can buy a listed option and It gets very technical about why this is a good ticket, but basically I bought a 415 trade and sold 275 for zero cost. When I was in the market, it was at 3600. If you actually go back through my stuff, I actually recommended in, was it July, June, somewhere in there, I recommended the 240 versus the, was it 340?
Something like that. It's 365 strike 410, put option strike 275.
I had another. I had the exact same trade, but everything lower down. It was 240 on the front and something else in the back. Was it 310? Yeah. Anyways, I mean, these same ideas. And what's important about this? I mean, first off, this is pure S&P risk. This is not an arbitrage. This is not a hedge. This is outright being long the market. But what's good about it is this. Number one, you're using options. And the option market makers, they don't care if you're buying or selling. They have a computer that's grinding it out. And they're making money, buy, sell, buy, sell, buy, sell. They have no position when the day's over. They need to make a very tight market. Therefore, they kind of lock up most of their inputs. And one of those inputs they lock up is where they borrow money at. And they borrow money at the best rate possible. Citadel, Susquehanna borrow money at the same rate as Merrill Lynch and Bank of America. So I'm basically buying assets at, 0.25% borrow rate. That's incredible. It's a much better borrow rate than you can do anywhere else. Also, if you actually own SPY or stocks in a portfolio in general of diversified stocks, you sell them now, take your gain, take your loss, take whatever, and you convert to this trade. Yes, you miss out on the first 9% of the up move, but you're protected down, 25 odd percent, right? Because you don't get put the stocks until you're 2750. I kind of like that profile, and I have the cash, and I can invest the money in something that some short-term bond fund that's going to pay more than 0.25%. So I'm kind of almost arbitraging that because I'm borrowing from Citadel at 0.25%, investing it at PIMCO at something at 1, 2 and change. What's wrong with that? So that's kind of that's how I get my exposure to equities, is via these long dated options as opposed to picking out names or actually buying. I'll tell you this. My son actually was looking at buying, and he's a Robinhood trader. He's had better than I have. I'll tell you that. In any case, he was looking at the ETF that's 3-to-1 up and down, right? Some ETF that pays off 3-to-1. And he said that the gossip is you don't buy that because as a long-term trade, it's a short-term trade. The answer is yes. The reason why is that if S&P yields a 2% dividend, if you're getting 3x the risk, then you better get 6% of dividend, but you don't. The ETF is absorbing the extra 4 points there, plus their fees. That's why these things are total losers over the long term. If you want leverage, why don't you go and buy a deep in the money long-dated call option? So the market was 3,600. I advised him, and he did it, shockingly. He bought the 2,600, the 260 strike call for 107 points. So he paid 7 points. He paid 7 points over the intrinsic. And he has an embedded put at 2,600, and you're only paying 107 versus buying the market at 3,600. So in theory, you could buy 3x and still have money left over. And so, and so basically, you're taking all the dividends, embedding them in the option. You're borrowing at the Citadel rate, and vols are low. So that was the vastly better trade to get exposure. If you want to buy and hold out for a couple of years, that's a much better trade than buying these 11 ETFs.
Oh, absolutely. That's man, I hope. Well, I feel like the options are just the next step. So these Robinhood traders start, they get their free stock when they sign up. I need to sign up for the thing. I've heard it's incredibly addictive. It's terrifying to me. But, the next iteration, you start looking at these levered ETFs, then you start trading options, then you start buying these deep in the money calls like this. I mean, this is going to have some impacts. So well, yeah. And then you can buy Bitcoin, and which is a levered bet on all of everything. So with this trade, the way that it's structured, because your call is above your price, you're missing out on this little price, but you're participating in the big move up, and then your put is below the price. So you are put those shares at a really attractive price if it does just tank,
Yeah,
right? But you're protected for a little bit,
you've
just for
got
the
to be willing. You got to be willing to own the market at that put price.
right. So
Um, and
don't sell like 10,000 shares or
oh,
10,000 put
in the real world, the optimal trade is if you own stocks, you sell them and put this trade on instead.
Gotcha.
That's that's the it's an asset replacement trade. Um,
Well,
and
but it's a shorter term, so you have tax
I mean,
implication thoughts like versus just holding the index, right?
there is a tax consideration that you got to think about, and that's up to you to figure out on your
Right.
own. I mean, my thought was that since Biden won, you're probably going to have higher taxes, so I'll take my taxes now at the lower cap rate because next year is going to be a higher cap rate. Is that really going to happen? Who knows?
Well, I mean, all of the things we've talked about, it's pretty unlikely that taxes will go down in any
That's a lot.
significant manner over the next forever. So I take that trade all day long.
But the option goes out to 2023. I mean, so you got, I mean, this is,
Right.
I mean, so you got a long time to go play with this thing.
Right. So looking through, we talked about closed in. You talk a little bit about long dated interest rate options and the European Dow. Do you want to talk about those trades as well?
The long dated rate option. Stay tuned. I'm going to find a way to offer this to the common person.
Oh yeah, that's the
Um,
one that's not available, right? Gotcha.
and the SX5E is listed on the Eurex in London or Germany. I think it's Frankfurt Exchange. Sorry. And this is a very similar idea. The math is identical. If you wanted to do the full on risk reversal, you can buy an at the money spot call and sell like a 26% out of the money put for zero cost. And that is because rates are negative in Europe. So you're borrowing at a negative rate compounded for 4 or 5 years. I mean, think about that. You're compounding a negative rate for years when you do some of these derivative trades, because derivatives need to price off the forward. The forward trades in the market, maybe not in public markets, but in private markets. And the forward is kept at the theoretical right price, because if it's not, arbitrageurs will come in, like when I was on Wall Street, and I would do this. I would force that thing to collapse, or I just take free money.
Right.
If you ever read Liar's Poker, Sally Arb, that whole thing, what those guys did, they were the first guys to do the futures forward trade and collapse things. That's how they made all that money.
I'm curious. I was expecting more. Something like real estate just makes so much sense to me right now because you're borrowing it at such low rates and you're locking in the price of dollars today in some asset that's going to appreciate, and then the rent is going up with inflation supposedly as well. I mean, is it crazy to be super bullish on real estate if you can buy something that's somewhat attractive right now?
I've always been a suspect of these of certain asset classes because it's unclear to me about the expenses involved. I mean, buying a diverse portfolio of residential real estate in a structure strikes me as interesting because I think it's very expensive to go and wash the floors, paint the walls, change the roof. I think it's very expensive to do on a grand scale. I think a lot of people use sweat equity to go and fix their places up. So when you see the guys on TV saying, I bought a house, I sold it, made a profit, I suspect that the guy did the painting himself.
Oh yeah.
If you were to go hire,
there's a lot of costs that aren't included there, right?
if you hire unionized management to go and do these things, it's expensive. So I mean, I think buying your own home is fine. I think taking out a mortgage. I mean, I think taking out a mortgage is my very first thing on that piece. Don't I? Or darn close to it. I mean, if you own a house, you should go and borrow money. You should go refinance now. That clearly is the best thing to do. And for most people, it's tax advantaged. And and if you could, I mean, I don't want to go and pump up home equity loans or those kinds of things that get too much leverage. But I mean, theoretically, if you can go and refinance, take out some money and pay off your credit card debt, and then promise not to go and build up more credit card debt, which is probably not going to happen, that'd be the right thing to go and do, because that is the cheapest money out there. But you don't want to go and take the equity out of your house, spend it, and then it's gone. I mean, equity in your home, the reason why the boomers have so much money as a group of wealth is that they bought real estate in the 70s and they never took money out of it. And so that investment was levered 5-to-1, right? Think about that. You buy a house for 100,000, you put down 20, you borrow 80. If it goes up 10%, so it goes from a $100,000 house to 110, that's up 10%, but on your money, it's up 50% because you've only invested 20K and you borrowed the 80. So so you made 30,000 of equity. The boomers basically bought their houses 5-to-1, and it just compounded for 30, 40 years. It's interesting if you go and take a 3 or 4% rate and take to the 40th power, it's a very big number actually.
Absolutely. Well, and this goes back to the original thing. The world's drunk on cheap debt, and the people that have been levered up to their eyeballs when everything's going up to the right, like it works out really well, and it gets really ugly really quickly if it goes the other way. But fortunately, we're in this world where asset prices only go up. That's for sure.
The good thing now is there is a window. I mean, volatility is relatively low. Things are moving around. Stocks are up and down, bonds are up and down, but things are basically pretty stable right now. You have plenty of time right now to go and adjust your portfolio as you like. Are you going to hit the all-time highs? Maybe, maybe not. But most things have come back to where they were in last February. The SPOOs and the FANG are higher. Some of the banks are lower, but really, you can move things around now, and there's liquidity in the market, so it can take size. You can get stuff moved around. You couldn't trade 10 shares, in March. Now you can trade thousands of shares at a clip. So here's your window, and adjust accordingly, which is great.
Yeah, you mentioned Bitcoin very briefly in your model portfolios, and just love to get your thoughts on this. We're talking about inflation. This is potential inflation hedge, also a potential massively speculative asset. You have a pretty strong opinion one way or another?
Well, the answer is yes. I mean, one of my favorite pieces is Tulips for the Masses. It's on my website. I shoot down Bitcoin, which it was written right near its previous high, something like 18,000. So I felt like pretty good at the time. Now, of course, I feel like an idiot. Now, here's the thing about Bitcoin. What is Bitcoin? Is it a store of value, or is it a speculative vehicle, or is it the means you use for blockchain transactions? If I could buy Blockchain Inc., I'd invest in that right now. Bitcoin is not buying Blockchain Inc. It's buying something else, buying the token that sits above that. Bitcoin is not viable as a means of transaction. It's just too cumbersome. I mean, if you compare the speed with which Visa, how many trades Visa does per day, it's gazillions, versus Bitcoin, I mean, really can't handle that many tickets per day. So it's really not viable presently as a means of transaction. It is not a store of value, period. It is not. It has a vol of like 50 or 60. The vol of the yen is like 6%. The euro is like 7. The pound sterling's 8. Russia's like 14. Okay, I mean, it is not a store of value. It is a speculative vehicle. Now, can it go up? Yes. Can it double, triple? Yes. People will say Bitcoin is a great investment because it's convex. What does convexity mean as you tell your mother or father or whatever? Convexity means you make or lose different amounts for the same result. If I make a bet, I can make $1 or lose $1, that's zero convexity. If I can make 2 and lose 1, that's positive convexity. If I can lose 3, make 2, that's negative convexity. Treasuries have slight positive convexity. Mortgage bonds have negative convexity. And all the geeks on Wall Street try to figure out how much more I should get paid for a mortgage bond versus a treasury bond. Bitcoin is positively convex to the extent they can. It's what, 35,000 now? How much can you lose? 35,000. How much can you make? Millions. So therefore, you can make more than you lose. It is positively convex. But that does not make it a store of value. Store of value means I have X number of loaves of bread, and I've stored the ability to buy loaves of bread into the future. This is not Bitcoin. That doesn't mean you shouldn't buy it, but I mean, it's not a store of value. I'm not sure what it is.
Yeah, I think that's. I mean, the market has buyers and sellers, right? And I think that the argument. I mean, I'm pretty bullish on Bitcoin for a while now. It's at $500 billion. Gold's at $10 trillion. The speed and transactions, these things are being solved. They're just technical hurdles. And it only has 12 years of history. So of course it's going to be very volatile and not serve as a store of value because it's so new. I mean, gold's been praised by people for thousands of years as somewhat of a store of value. But just looking at gold versus Bitcoin, I mean, Bitcoin is divisible into a tiny fraction. It is transferable peer to peer. I can memorize 12 words in my head and walk through a military line that's shaking me down and pulling all the gold coins out of my body. And assuming that there's internet wherever I go and another person willing to buy this, I can transact and get the local currency at that point. So these are aspects of it that make it very desirable as a potential store of value. But I agree. Right now, it's very speculative. And I tell people,
get one small detail, okay?
Yeah.
Let's do this up a notch, okay? If you want to play, Bitcoin is an act of war against a sovereign nation, okay? Because what is a country really but its currency and how they, because that's how they
tax people.
So the U.S. government does not want Bitcoin to be, to take over the U.S. dollar. Being the reserve currency of the world is, and our military is the power of the country.
Very
that
advantageous.
That ain't going away. And so what's going to happen is this: at some point, Bitcoin, they're going to declare Bitcoin not like gold, a commodity. They're going to call it a bank account. And once it's a bank account, you'll have to go and your tax forms. If you, I mean, I've owned foreign bank accounts. If you own them, which is totally legal, you got to disclose them. If you don't disclose them, what happens to you?
Oh yeah, the F bar. I fill it out every day,
You go to jail.
Yeah.
Okay. So this whole notion of I have my 12 words, I go off through the board, and Al Capone did not go to jail for drugs or bootlegging or murder. What do you go to jail for?
I actually don't know. Tax evasion.
Tax evasion.
Yeah,
tax evasion. Okay, so when they have, when the government decides to do it and they make you, disclose your F-bar and you don't do it because you have some clever idea, you're small fry, no one cares. If it actually means something, then they'll put you in jail. And if you want to go and risk being in jail, be my guest. I mean, lots of things you do are illegal. But once that happens, it will not be as much fun for people. And the Russians and Chinese, when they find, I mean, that's why you have, with 95% of Bitcoin's owned by 1% of the people, because they can't get the money, because if they actually ever try to type their 12 words in, the Russian or Chinese government will go and shoot them. We don't shoot people in this country yet. But I mean, so I think this notion, now, can Bitcoin get to 100,000 or 500,000 before that happens? Yeah, why not? But let's be clear, the US government is not going to go and encourage a lot of Bitcoin to go and become the currency of the realm. And this idea that digital currency is coming, yes, we already have that. It's called Venmo.
Yeah.
Okay, so I mean, it's a great speculative vehicle, and if you want to go and speculate, be my guest.
Yeah, no, and I agree. I mean, we're going the route of fully digital, then you can push monetary policy, fiscal policy directly into your wallet that's controlled by the Fed, cut out a lot of middlemen. There's tons of benefits. But FBAR, I have foreign bank accounts. I report them. It's not illegal to have those. So I do agree that Bitcoin will go that way, and I'll have to disclose those. And if it gets to a value that's too high, and a existential risk to the nation state, then yeah, in a place like Russia or China, perhaps you are at risk and you don't disclose, and then once they do find out, you are even more at risk. But yeah, it's that's an interesting thing to think through for sure.
I would venture to guess that if you pull aside most Bitcoin people and ask them the reasons why they're in Bitcoin, aside from the fact that it's going up, they'd probably say something like, it's money off the grid. And that's the whole point, is when that's false. It's just not on the, it's just the government hasn't put it on the grid yet, but they will.
But that's how, I mean, I can buy a gold bar with a bag full of cash and put it in a safe at my house, and that's out of the system, off the grid, pretty untraceable, especially because it's physical.
If you have more than $10,000 and you try to put that cash into the banking system, then
getting it back into the banking system. But I'm saying that gold bar sitting there,
$200,000 of cash in your hand, like, what are you really going to do with it? Because you really can't buy anything with it without having flags get raised.
Right. So that idea of having the gold bar, it's like that, but I can break it into $3 increments, so I can pay the gardener or whatever. Yeah.
Your gardener. I agree.
Yeah. It'll take a long time when Bitcoin's at $10 billion per coin, right? Harley, I want to be aware of your time. I think we've gone into a lot of great detail on some really good trades and some really good macro views. Again, I'll link all of these things in the show notes, your website, some of these pieces that we've talked about. I'll try to dig up that Chris Cole one as well, because I think that's quite important. But yeah, where do you want to leave my listeners? Where can they find out more about you, what you're doing?
Our website, convexity.com, harley@bassman.net is the email. It's on the website. The better website actually is bassman.net, which is where I have our family vacations. If you're listening to this, you can probably afford a vacation. Go and do it. You are not irreplaceable. The graves are full of irreplaceable people. And so I'll tell you this. One, it's all about character. Thank God that's worked. And two is you're born, you live, you die, and you're dead for a very long time, like much longer than you think. So you should don't waste your time with your head buried in the office. Get out there, enjoy your kids, enjoy your family, and you can't take it with you.
Those are the important things. What a wonderful way to leave it. Well, Happy New Year, Harley. Really appreciate having you on today, and thanks for all of your wealth of knowledge you dropped here. There you go. First off, thank you very much for listening all the way through. I hope you got a lot of value out of that conversation. As always, you can find show notes, links, and more at altassetallocation.com. Please share this with anyone you think might be interested and derive any value from this conversation. And as always, you can reach out to me for any feedback or questions. Please give the video a like, or even better, subscribe on YouTube or your podcast player of choice. This really helps others find the podcast or the video as well. Thanks a lot. Hope everybody has a fantastic day, and stay safe out there and invest wisely. Cheers.